All right, so if I was going to explain investing to somebody that didn't know anything about it, basically, it's like a bank account, all right? And so your money could be up, like let's say you had 500 shares of this company, but maybe you got it into this company in when it was $3. So now, no matter what, as long as this company's above $3, you have earned money, right? But what markets is, right, is you would invest in different companies, different times, right? You want to try to invest when they're low. So, and then you grow with them, right? So if you invest in Archer at 3, now it's going to be up here sometimes, but then it dips, right? So you can buy more too, because then you build your confidence in a company. You might have a company like Humacyte where you're waiting on something and it's not happening, even though they do have the FDA approval. So when you think about where you're going to put your money, it can be difficult because a lot of times companies can be in the red, all right? Or bad stuff can happen in the company. Well, not bad stuff, but like you might put a lot of money in a company and then you're all happy because it's up, right? Like this guy could be up like this. And then let's say it goes down, down, down. You have to keep in mind the time it was up, 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 because you might have lost money. So that's why you want to also have a balanced portfolio. And you also have to expect that sometimes shit will be in the red. So you find SoFi is one. Actually, there you can invest in SoFi stock too. And you would put your money in these, either SoFi, you have Robinhood's a good one people like. Now, you have it like wired to your bank or connected to your bank account. And with your investments, you can take these out whenever you want, but it can take 5 to 7 days, depending. It's quicker to put the money in. But then you also want to remember that when it takes it, a lot of these like public, when it takes the money out of your account, it can show, to wait a couple days to show. So that's how markets would work. And at some points, you start to accumulate because then you also want to get into your good guys set, right? So let's say you didn't take any like risky ones. Like Rocket Lab could have been considered a risk to some people over the summer. Now, not so much. Like Rich Tech Robotics is still definitely a risk. They don't have the partnership with Walmart, but Archer, I don't consider it too much of a risk, but they're not flying in the sky yet. They're not commercialized. So you also want to have some, or if you weren't interested in risk or looking at stuff, if you would have invested in Amazon this time last year, you would be up 50%. So that's a lot better. A 50% return is a lot better than just a regular little savings account. But there's all different kinds of accounts. You can also get like a Roth that can, this is for tax purposes. So you could put the $7,000 into a Roth and then you get it when you're 58. So there's difference between Roths or traditionals. Those are some you would have to wait 5 years before you can take stuff out. But with these types of accounts, you could also just have an individual investor account. So you have individual, but then for taxes, that can be, obviously this is an investment advice. But with the Roth, there are times you can take out the money, like a medical emergency or a first-time home buyer. So Roths could be really beneficial to people who want to save money for like 5-10 years at maybe a faster return than something like your typical bank account, which I don't even know if it gives you interest. But that would be for beginner investors. A little explanation.